Canada Goose's shares rise after beating analyst expectations. Net income of 12.5 million Canadian dollars, down from 58 million, but that still beat analyst estimates. And they had revenue of 195 million, down from 294 million. National Bank reduces its earnings estimate for Keyera to 145 per share, down from 155 per share. The company still rates this stock as outperform with a price of $27 per share. Let's look at these stocks a little closer to figure out whether they're a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I'm going to walk you through the process of valuing Canada Goose and Keyera stock by analyzing their financial statements and dissecting their financial ratios so we can determine if they're a buy or a sell. Canada Goose Holdings is a holding company of winter clothing manufacturers. The company was founded in 1957. Canada Goose markets a wide range of jackets, parkas, vests, hats, gloves, and other apparel through wholesale and direct-to-customer with their own retail stores. And both stocks we're looking at trade on the Toronto Stock Exchange. Let's get started with the model. Canada Goose is a mid-cap company, market cap $4.9 billion. They're trading at $44.29 a share, and they have 59 million shares outstanding. The way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And this company has positive free cash flow every year, except in 2020 they didn't have much free cash flow. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have positive and growing net income each year, which looks pretty good. Revenue is the sales for the company, and it more than doubles from 2017 to 2020. So their revenue is moving in the right direction. This is the company's income statement. The top line is the revenue, the sales for the company. In 2020, that was $958 million. The cost of revenue, which are the expenses directly related to making the sales, is $364 million. And they had their highest gross profit in 2020 of $593 million. Gross profit is sales minus cost of sales. But their operating expenses were also really high in 2020, $401 million. So even though they had much higher sales in 2020 than 2019, their operating income was lower in 2020 compared to 2019. They also have interest after paying their debt and other expenses. So they did have positive net income in 2020, a little higher than 2019. This is the company's sales in 2018, 19, and 20. The country with the most sales is Canada, but it's really close to the amount of sales in the United States. But they also have a decent amount of sales in Asia and Europe, so they're pretty diversified in their sales. This is the statement of cash flows, and to calculate free cash flow, it's cash flow from operations, which is on top, minus capital expenditures. So in 2020, they had $63 million of operating cash flow, and almost the same amount in CapEx. CapEx are investments in property, plant, and equipment. CapEx is good because it's investing in your company to hopefully grow later on. Although they pretty much broke even in free cash flow, in prior years they have positive free cash flow. So everything looks pretty good so far. Let's look at the capital structure. $386 million of debt, $520 million of equity. They pay 5.4% interest on their debt, and cost of debt is 4.3%. To calculate cost of debt, it's interest rate times 1 minus the effective tax rate. And 43% of that capital structure is debt, which means 57% is equity. Cost of equity is 15.68%. To calculate cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And their beta is 1.74, so the stock is a bit volatile. It moves almost 1 3/4 times the market. Their WACC is 10.83%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $3.1 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $2.6 billion. We divide that by 59 million shares. We calculate a stock price of $43.79. They're trading at $44.29. So the model predicts a value almost exactly to where the company's trading at. So simply Wall Street's valuation is $55.37. So they're saying the stock is 20% undervalued. They're saying it's a buy. You may be wondering why my model estimated free cash flow that was much more than our actual free cash flow. The reason is because although they had low free cash flow, the model looks into account the growth of the net income and the growth of the revenue, and it takes that into account, not just a free cash flow. So you can see the stock IPO'd in 2017 and it touched about $90 a share, but has been cut in half since then. It's trading at 44 now. So it looks like it could be a good value. They offer great products. And this company doesn't pay a dividend, but if you invested $10,000 in this company when it IPO'd, you'd have $21,000 today. That's 110% return. Let's look at the financial ratios. The average PE is 14.9, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 17.3, so they're a little worse than the median and average. Average price to sales is 5.3, the median is 2.1. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 2.7, so they're between the median and average. The average price to book is 4.5, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 5.0, so they're pretty close to the average. Equity is assets minus liabilities on the balance sheet. The average interest coverage ratio is 12.2. The median is 3.8. Interest coverage ratio is EBIT over interest expense. They're at 9.1, so they can easily cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. The average ROE in the market is 11%. The median is 12%. ROE is net income over equity. They're at 29%, so they provide a good value to their equity holders. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They're at 2.6, so they can easily cover their current liabilities. Generally, you don't want to see a current ratio above 2 because that can indicate the company is operating inefficiently. Their current assets are cash of $31 million, receivables of $44 million, inventory of $412 million, so they're sitting on a lot of inventory. Of course, this company needs a lot of inventory, but you don't want to sit in too much inventory and have it go bad and lose money. The best way to look at ratios is to compare them to similar companies. I've done videos on Capri, Hanes, and Levi, all in the same industry as Goose. And if Goose has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in all the price multiples, PE, price to sales, price to book. They have the highest current ratio of all the companies because they're sitting on so much inventory. Their ROE is about average. They're lower in debt than average. In market cap, they're pretty close to the average of $3.6 billion, average is $4.1 billion. And they don't pay a dividend similar to Capri, but Hanes and Levi pay a decent dividend. So to summarize, I value them at pretty much what they're trading at. Their ratios and their financials look decent. The next company we're going to look at is Keyera. Keyera is one of the largest midstream oil and gas operators in Canada. The company services oil and gas producers in Western Canada and transports natural gas liquids throughout North America. Let's get started with the model. This is a mid-cap company, 4.6 billion market cap. They're trading at 21 a share, and they have 221 million shares outstanding. Their free cash flow looks pretty weak. They have negative free cash flow in 3 years, positive in 2020. Net income looks good. It's positive and consistent. Their revenue doesn't look so great. It jumps a lot from 2017 to 2018, then drops in 2019, then drops again in 2020. This is the company's income statement, and this column is a trailing 12 months. And they had revenue of $3.4 billion, cost of revenue of $2.6 billion. They did have more gross profit than in prior years, $857 million. Their operating expenses are pretty low, so their operating income looks pretty healthy, $745 million. They also have to pay interest on their debt. Then they have quite a bit in other income. Other income is usually impairments or restructurings, acquisitions, things like that. So the company does have healthy net income each year, which looks pretty good. This is the statement of cash flows, and to calculate free cash flow, it's operating cash flow minus capital expenditures. So you should always look at operating cash flow. That's a better indicator of a company's health than net income because this takes into account actual cash that goes in and out of the business. So they did have positive and growing operating cash flow each year. But the reason they have negative free cash flow some years is because they have so much in CapEx. CapEx is investments in property, plant, and equipment. And some businesses have more CapEx than others, especially oil and gas midstream companies. But you need to invest in CapEx to grow your business. So hopefully in the future, you get more free cash flow from the investments in capital expenditures. So you can see each year they're issuing a decent amount of capital stock, $674 million in 2017, then $200 million, $226 million, another $200 million. Capital stock is common stock or preferred stock. And they also issued debt, $3.7 billion in 2017, $1.1 billion in 2018, $1.4 billion in 2019. So they really need a lot of money to finance their business. But if you look in 2017, they issued $3.7 billion, but they paid off $3.6 billion. That's just rolling their debt. When debt is due, most companies don't pay it off. They just get new debt to pay off the old debt. Let's look at a capital structure. $2.8 billion of debt, $3.1 billion of equity. They pay 4.06% interest on their debt, and cost of debt is 3.1%. And they have 48% debt in their capital structure, which means they have 52% equity. And they have a really high cost of equity because their beta is really high, 2.51. The beta is the volatility of a stock. The higher the beta, the higher the cost of equity. So their WACC is 12.79%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $3.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.2 billion. We divide that by 221 million shares. And we get a calculated stock price of $14.40. They're trading at $21, so they're trading at a 45% premium. It's a sell according to the model. Simply Wall Street's valuation is $37, so they're saying it's a strong buy. So it makes it difficult to value companies with negative free cash flow. So I was a little more conservative with the future free cash flows, but I still came up with a value much lower than simply Wall Street. So you can see the stock was pretty steady between $30 and $40 for a couple of years, but then it dropped like a rock in March like most other stocks. It came up a little bit, but it's still sitting at a pretty big discount from its all-time high. This company pays monthly dividends 16 cents a share. Their dividend yield is 9.58%. So they provide a great dividend. If you invested $10,000 10 years ago into this company and reinvested those dividends, you'd have $12,600 today. But if you did not reinvest those dividends, you'd have $14,000 today. Even though the company pays a nice dividend, the stock price came down so much, you're better off putting your dividends somewhere else than back into this stock. Let's look at the financial ratios. Price to earnings is stock price over earnings per share. They're at 16.1, so they're pretty close to the average and median for the market. They have a really good price to sales ratio of 1.4, that's stock price over sales per share. So investors are paying $1.40 for $1 of revenue. They also have a really good price to book of 1.5, that's stock price over book value per share. Much better than a median and average. Their interest coverage ratio is good at 5.5, so they can easily cover their interest payments. The ROE is a little lower than the average at 9%, that's net income over equity. And their current ratio is also a bit low at 0.8, that's current assets over current liabilities, so they cannot cover their current liabilities with their current assets. Their current assets are $656 million, that's $9 million of cash, $488 million of receivables, $94 million of inventory, and some other items. So they don't have the best asset, which is cash. They have a lot of receivables, so they're extending a lot of credit. So in some industries, you have to give credit out. You don't want to give too much credit out because it ties up cash flows, and when you need cash, you're going to have to borrow. Also, if you give out too much credit, you run the risk of not receiving payment if the company you're giving credit to goes bankrupt, or they have to renegotiate their terms. The best way to look at ratios to compare them to similar companies, I've done videos on 43 oil and gas midstream companies, and these are just a few of them. And Keyera is right here. If they have a number in green, they're better than the average. If they have a number in red, they're worse than the average. So their PE is 16, the average is 5.2, so they're much worse than the average, but they are better than average in price to sales and price to book. Their current ratio is pretty weak at 0.8, much worse than the average. Their ROE is a little better than average, they're at 9%, average is 7%. They're also doing better in debt than average at 48%. They're about half the size of the average oil and gas midstream company, $3.5 billion, average is $6.9 billion. And even though they pay a high dividend, the average in the industry is 12%, they're at 9.58%. So to summarize, I have them trading at a 45% premium. Their ratios look good and their financials look decent. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.